Hello and welcome to the UBB podcast. My name is Peter Kinsella, Global Head of Foreign Exchange Strategy.
And I'm Ksenia Mishankina, Senior Credit Research Analyst at UBP Asset Management.
Today we're going to talk about the Turkish Lira and the implications of potential Lira depreciation for the Turkish banking system. As most investors will know, over the last number of years, the Lira has experienced a pretty profound and rapid depreciation, in particular last year. The reasons for that depreciation are quite well known. Inflation rates in Turkey have averaged around 7, 8 or 9% year on year. Inflation expectations have been quite elevated. Turkey runs a very, very large current account deficit. And indeed, on top of all that, there's been lots of political uncertainty allied with a rather dubious central bank stance regarding the independence of the institution. The Turkish central bank has run a consistently flat to negative real interest rate policy over the last number of years. And that's resulted in very, very high levels of trend inflation in Turkey. The issue came to a crunch last year when we had a situation of both political tensions, potential sanction on Turkey from the United States, and of course a big spike in Turkish inflation. The Turkish central bank responded to this with a series of emergency interest rate hikes, such that interest rates at the current levels are of around 24%. Over the last number of weeks, we've seen that a rather profound return of political interference in the central bank with the removal of previous central bank governor Murat Çetinkaya. It seems that Mr. Çetinkaya's replacement is quite fond or quite keen to reduce interest rates over the coming weeks, and markets anticipates that the central bank will cut rates quite aggressively in the coming weeks from anywhere between 200 and 500 basis points. At the margin, this should lead to a return of modest Lira depreciation. The risk, however, is that later in the year, Lira may well depreciate more aggressively. And that's because inflation levels, which have been declining in the last number of months, could well accelerate pretty much by the third or fourth quarter, just as a reflection of base effects. Overall, the outlook for the Lira is still, in our opinion, rather tenuous. We think the Lira could depreciate more aggressively in the second half of the year. Now, on that point, we'll then have a look at the implications for the banking system. So, Ksenia, in your view, what do you think are the main implications for the banking system as a result of continued Lira depreciation?
So we are particularly concerned about the impact of Turkish Lira depreciation on the bank's capital. In this respect, we look at two scenarios. Under our base case, we expect Turkish Lira to depreciate to 6.5 against the dollar in the second half on average. And combined with asset quality deterioration, which would translate into NPL ratio increasing to 10%, would imply that the banks would require about $4 billion of fresh capital. However, under a stress scenario whereby Turkish Lira depreciates to 7.5 against the dollar in the second half, would imply a capital shortfall of around $6 billion.
That's pretty significant. And I mean, is there anything the government can do about this? What measures could they take to kind of make the situation better?
Absolutely. The government has a number of levers to pull before the situation deteriorates significantly. First of all, as we have seen last year, the government allowed the banks to use the old exchange rates. Thereby, the banks were able to remain Basel III compliant with respect to their capital ratios. Secondly, the new central bank governor is considering introducing potential measures which would encourage privately owned banks to resume lending. He's considering imposing certain penalties on the banks that have low lending rates. As per the recent data, we have seen that loan growth contracted by 2% for privately owned banks, and state-owned banks saw their loan books expanding by only 2%. Therefore, across the banking sector, the loan growth stood at around zero. And thirdly, the government may choose to provide direct capital injections, as it has done in April this year. Overall, the government has committed about 3.4 billion euros for state-owned banks.
Okay, so that's pretty significant. And I mean, would that be enough in your view? I mean, what do you think? Where if the banking system isn't, let's say, the best investment or the best place to put your money, where is in your view?
Whilst we remain concerned about Turkish banks, we believe that blue chip Turkish corporates are a safer option, particularly those that have large part of their revenues denominated in hard currency. Blue chips have successfully come to the market in the first quarter of this year and pre-funded their short to medium term maturities, thereby effectively creating hard currency liquidity buffers. For example, Koç Holding, they generate about 50% of their revenue in hard currency, whereas no more than 50% of their costs is in hard currency. Overall, we believe that exporters have a natural hedge given a high portion of their revenues denominated in hard currency and therefore are more resilient towards local currency depreciation.
Okay, so overall, the corporates then seem in pretty good shape compared to the banking system. What about the further challenges? I mean, what else is there in your view that could be sort of a potential sort of a danger point in your view?
We are particularly concerned about low rollover rates. As per the recent data in May, we have seen that rollover rates have declined to as low as 58% for privately owned banks and stood at around 70% across the system, sort of including corporates and banks. While this is not a problem for privately owned banks because they're sitting on high liquidity buffers denominated in hard currency, this could be an issue if it persists for Turkish corporates. In particularly, Turkish corporates had external debt at around 72 billion US dollars over the next sort of 12 months, and this external debt is predominantly denominated in hard currency.
Wow, so overall a pretty messy situation in some. Well, there you have it. Thanks for listening, and we look forward to basically updating you in the coming months with the latest developments. Thank you very much.